Hello, it's Carla Merlat, President of Merlat Tax Advisory Group, with video number 2 in our series of Getting Your Financial House in Order. Most importantly is I hope you took action on our first video and you're ready to take action on our second video. Remember, you hold the power to control your financial future. Let's get there together. In our last video, I explained how to uncover money that you may not even know you have, and also to take inventory of your assets. If this homework is done, then you are ready to move on to this next video, understanding how your money is positioned. Once this is completed, we will follow up with our future videos as listed. Each type of asset that you hold comes with one of two risk factors that could either be interest rate risk, meaning that you're not keeping up with inflation, or market risk, that you have the potential for high earnings, but you also have the potential for sometimes substantial decreases. So we want to uncover what type of account you have, how much you have there, what percentage of the assets that represents. Am I earning interest, and if so, how much? And is the money exposed to market risk? So we're going to go to the next slide and do an exercise to determine this. By having your financial inventory in front of you, we are now going to categorize it, see if you are comfortable with the risk associated with your investments, and compare it to others of your age. So with the inventory sheet in front of you, you will have both qualified, meaning IRA, 401k, 403b, retirement assets, and non-qualified assets. So the first thing I want you to do is look down your list, and if you do have any indexed annuities starting at the far right side, we want you to go ahead and list the dollar amount in that category. Do the same for fixed annuities, CDs, which would be at the bank, and then cash would be your checking, savings, and money markets. On the opposite side, the riskier side of the scale, we want to list from the far left individual stocks that you own, mutual funds, again, whether it's in your IRA, 401k, or in just a separate brokerage account, any variable annuities that you have, and bonds, whether they are individual bonds or bonds mutual funds. Once you have a dollar total above each of these categories, I want you to total everything on the right side of the scale, the CDs, the cash, the fixed annuities, and indexed annuities, and write a total on the right-hand side. Do the same for the risk side, adding up your stocks, mutual funds, variable annuities, and bonds. Put that number on the left. Add both the left side and the right side together to get a total, which you could write directly below the scale. Now divide the right side number by the total to get a percentage, and write that percent on the right. Do the same on the left. Take your left side total, divide it by the total, and put the percentage there. This is the starting point to know how your assets are positioned. Now that we know where your assets are positioned and how much are on each side of the scale, what do we do now? Well, there's a lot of factors that come into play, and this is where I recommend that you do sit down with a financial professional like myself to see if your assets are positioned where you're most comfortable and that they're going to do the best job for you. Some factors we need to take into consideration is your age, the assets that you do have to work with, your years to retirement, your lifestyle now, in your early years of retirement, and also in your later years of retirement. Your health becomes a factor. Your taxes are a huge portion of deciding where your assets are positioned and how you will withdraw them. And also other income, such as pensions, other annuities, inheritance, dividends, and interest. In closing, I do want to comment that the way your assets are positioned has a lot to do with the risk tolerance that you have and your age and retirement plans. There is no cookie cutter approach. And that's why it's critical to meet with somebody who can guide you and make sure that you are comfortable with the risk that you are taking with your money. Let's say, for instance, you have $300,000 and you have $150,000 on each side of the scale. Well, what that means is that $150,000 of it is safe, protected against loss, but you may not be earning enough interest on that side in order to keep up with inflation. Once you start drawing from that money, you'll be depleting it too quickly. On the flip side, if you have the other $150,000 on the risk side of the scale, and say the market goes down like we've seen in the past, say 40%, and you lost $60,000 of your $150,000, how would you feel? Your next statement comes and you have $90,000. We want to know how much you could lose and if you're comfortable with that. If you are, great. If not, then it may be time to make some changes. And what's the most important part of watching these videos? Taking action. I encourage you to set a time with a financial professional like myself in order to get some of your questions answered, see what your options are, really have a solid plan so you can have that retirement of your dreams. Remember, you hold the power to control your financial future. Let's get there together. Give us a call, set your complimentary review, or you can email us. And I'd also encourage you to visit our website for the blogs that we're posting there, and if you want to get a little bit more background about me. I look forward to meeting with you.